So your mortgage is pre-approved. Don't buy the house yet before watching this video. So you got approved for $900,000 home. Congratulations. But here is the question most buyers forget to ask. Can you actually afford to live in the house after you buy it? A mortgage pre-approval tells you approximately what you may qualify based on the lending criteria. It does not automatically mean that buying your maximum approval is financially comfortable. And pre-approval is also not the same as final mortgage approval. Hi, my name is Jimmy Singh. I'm real estate broker for 20 plus years and a mortgage agent. And here is 5 reasons being mortgage approved does not necessarily mean you're comfortably going to afford the house. Number one, your lender looks at the ratios and your life has more expenses. Mortgage qualification considers things like your mortgage payment, property taxes, heating, condo fee where applicable, and other debts. But in your real life, it may also include childcare, groceries, gas and transportation, cell phone, internet, insurance, vacations, family obligation, and unexpected expenses. Ontario mortgage regulator also tells us that debt to service ratio do not reflect the full picture of affordability for home owners. So qualifying for mortgage and comfortably living with the mortgage are two different things. Point number two, buyers often forget the ownership cost. Your mortgage is only one bill. Before and after closing, you may face land transfer tax, legal fee, disbursement, title insurance, home inspection, appraisal or lender related cost, moving expenses, property taxes, home insurance, utilities, maintenance and repairs. Financial services regulator, they recommend having funds available for closing and suggest approximately up to 2% of the purchase price or more depending on the transaction. In my experience over 20 plus years, I have seen if you are buying a pre-construction condo in Toronto, your closing cost might be close to 3 to 4% of the transaction. And Canadian Mortgage Housing Corporation 2026 survey found that the 32% of home buyers experienced unexpected cost, while moving, repairs, legal fees are among the common surprises. Point number three, the unexpected expenses can make you house rich and cash poor. Imagine buying a house and then 6 months later, the furnace stops working. The roof need attention. Your basement leaks. Your property tax increases. Your insurance cost rises. Or you suddenly lose your income or face a major family expense. So we recommend planning for maintenance, repairs, emergency, and specifically suggest keeping emergency saving funds in a separate account 6 to 12 months. My personal rule of caution, don't put every single dollar in down payment and closing. Depending on your income stability and personal situation, consider aiming 6 to 12 months of accessible saving and essential expense reserves. That is your personal financial buffer, not a lender requirement. And the right amount can vary from buyer to buyer. Point number four, don't buy a house only because the basement will pay the mortgage. I hear this all the time in social media, TikTok, and everywhere. Don't worry, you can rent your basement. Maybe, but ask yourself, is there actually a strong tenant demand in your specific neighborhood? What if you bought a house suburbs far away from a big city? How much competing rental inventory is available there? What happens if your house sits vacant for months? What if tenant move out unexpectedly? What if rent is lower than your expectations? What if repair and upgrades are required before renting or city bylaws want them to be retrofitted. Rental income surely can be helpful, but do not build your entire home ownership plan around every dollar of expected basement rent arriving every month in a timely manner. Your budget should have vacancy and contingency plans. Point number five, do your own stress test, not just the bank's. Lenders already apply a mortgage stress test using higher of the qualifying benchmark or your contract rate plus 2%. But passing that test still does not capture your entire lifestyle and your household budget. So let's do your own financial test and ask yourself, if mortgage rates rise in future, my income drops, I get laid off, I lose my tenant for several months, or I have to do 10,000 worth of repairs in my house, can I survive the financial without going into high interest debts? And we also caution a lot of people that borrowing to the maximum you're allowed by a lender could be risky if income falls, expenses increases, or rates rise in future. So the final takeaway or the bottom line is a mortgage pre-approval should be just your starting point, not your spending limit. The bank may tell you what you can potentially borrow, but only your complete budget tell you what you can truly afford. Sometimes buying a 50 to 100,000 below your maximum approval can mean a difference between enjoying your new life and becoming house rich, cash poor, and financially stressed. Buy a home that fits your lifestyle, not just a number that fits a lender formula. Thanks for watching.